great returns secured by real estate without being a landlord? Welcome to private lending. It's one of the best kept secrets of wealth building. But not all private lending is created equal. There are three main approaches, and each one comes with different levels of work, risk, and reward. Let's talk through them so you can choose what fits your goals and your schedule. First, there's the do-it-yourself model. You find a borrower, lend directly, and you keep the full benefits, usually both the interest and the upfront fees. This method often offers the highest potential returns, but it's also the most demanding. You have to source borrowers, evaluate deals, analyze property values, draft legal documents, collect payments, record the deeds, deal with delinquencies, track insurance and compliance. If something goes wrong, like a default or a foreclosure, it's your responsibility to handle the recovery process. And that's not just hypothetical. A friend of mine lent on a property that went into foreclosure. It took 2 years to resolve, and during that entire time, her capital sat idle, earning nothing. Plus, she had to pay legal fees to fight for her own money. The second way to lend money is by working through a loan broker. They bring you deals and sometimes provide the paperwork and connect you with an attorney to structure the whole thing. You still lend directly, and in most cases, you earn the interest on the loan while the broker keeps the fees. This takes less time than going solo, but you're still reviewing deals and signing off on the risk. And just like DIY lending, if a loan defaults, it's still your problem to solve. The third option is investing in a fund that lends on your behalf. This is the most hands-off approach. You contribute capital, and the fund manager takes care of everything: sourcing borrowers, underwriting deals, drafting documents, and managing any issues that arise. You don't get the full interest rate the fund charges to the borrowers, but rather a set return based on the amount of capital you contribute to the fund. At first glance, the returns may look lower than you would be earning if you're lending directly. But here's what most people miss. In the real world, DIY lenders often have gaps between deals. Maybe your last loan paid off, but you haven't found the next one yet. So that's time when your money is earning nothing. Or maybe you've got $50,000 left over that isn't quite enough for a full second loan after you funded the first. That's unused cash, and it's earning 0%. And then there's the risk of loss. If a loan goes bad, you might spend months or even years in legal battles trying to recover your money. During that time, not only are you not earning, you might even lose part of your investment. Funds eliminate both of these issues. There's no downtime. Your money stays at work month after month. And because the fund spreads its capital across many loans, the risk is also spread out. If one loan underperforms, your monthly payment isn't impacted. One example of this type of structure is the Blue Vikings Income Fund, which is fully managed and designed to deliver consistent monthly returns to investors with zero hands-on involvement. So what's the best private lending approach? If you want the highest potential returns and you're willing to do all the work and take all the risk, DIY lending could work for you. If you want easier access to deals but still manage risk and paperwork, a broker might be the way to go. If you want steady returns with none of the effort or exposure of single loan risk, consider looking into professionally managed lending funds. There's no one-size-fits-all answer, but understanding your options and the trade-offs can help you grow your money smarter, safer, and faster. Want more strategies like this? Hit subscribe and stay tuned.